Hello and welcome back to the channel. Today we're going to be getting into the question, is the economy headed for a deflationary bust? I've had multiple requests to make this video, and it seems like every day there are more and more top callers on X calling for a recession and calling for a deflationary bust. So we are going to be getting into that today, and we're going to be looking at yield curves, rates, unemployment, liquidity, the US dollar, and the US debt. So before we get into it today, guys, don't forget to like and subscribe, and also to turn on post notifications so that you don't miss any of my future videos. So let's get right into it. So multiple people are pointing at the yield curve as evidence that we are about to enter a recession, because every time we see an inverted yield curve paired with a flattening Fed funds rate, the US economy is heading into a recession. When the Fed starts cutting rates and the yield curve flips positive, we're on the brink of a recession and a major market crash. This market currently has an 85% correlation with the summer of 2007, and this time will be no different. And there are multiple people calling for this. And if you don't know, the US yield curve of the 10-year Treasury versus the 2-year Treasury has been inverted really since mid-2022. So it's been inverted for a while now, but is slowly making its way up to be uninverted, and people are using that as evidence that we are going into a recession and a major market crash. So a quick lesson on the yield curve. A normal healthy yield curve looks like this, where the yields on shorter term treasury bills is lower than the yields on longer term bonds. And that is because if you are locking up your money in a long term bond and locking up your money for a longer amount of time, because you are taking on more duration risk, you expect to be rewarded more lucratively than if you are taking on less duration risk. However, an inverted yield curve looks like this one in the red, where the yields on shorter term bills are greater than yields on longer term bonds, which is generally opposite of what you expect, because it means you are receiving less yield for holding longer duration and receiving less yield for locking up your money for a greater amount of time. And generally, the reason this happens is because forward-looking indicators are so bad, there is an extremely high amount of demand for longer duration bonds. And that high demand pushes the price of bonds up and therefore the yields of the longer term bonds down. And this is people just doing whatever they can to get those longer term bonds and that fixed income, because then if forward-looking indicators are so bad, then at least you will have that fixed income, even if it is at a low yield, and you are willing to accept less yield on that duration. And so the current US yield curve looks like this, with shorter treasury bills paying out higher yield than the longer-term bonds, whereas a more normal yield curve would look something more like this, where longer duration also has a higher yield. And so typically that is a very good recession indicator. However, there is one thing that most people are overlooking in this scenario, and that is something called activist treasury issuance. And I'm not going to go too much into this, but the gist of this is that the US Treasury Department typically will sell around 80% longer duration bonds and around 20% shorter duration treasury bills when they go to market. And so typically they have been at around an 80-20 ratio. However, for the past few years, the Treasury has been issuing around 80% shorter term treasury bills and around 20% longer term bonds. And the reason that they have been doing this is because it is essentially a form of stealth QE. Because shorter term bills act more like money and are more liquid than the longer term bonds. And so it essentially acts as a form of monetization. And so they have been doing this in a way to add liquidity to the economy. And the inevitable result of this is that because they are issuing less longer term bonds, therefore cutting the supply of longer term bonds, the demand for longer term bonds stays the same. This will therefore push up the price of longer term bonds and therefore push the yields of longer term bonds down, and vice versa for short-term treasury bills. By increasing the supply, they drive the prices down and therefore keep yields elevated. And so it is essentially a form of yield curve control. And so when you look, for example, at something like the US housing market instead of the US Treasury market, which is not being manipulated in the same way, the yield curve is actually normal. And while it has been lowered, the yield curve never reached that inverted state. So as you can see here, the actual 10 to 2 year yield curve in orange has inverted and has been below zero since 2022. But when you look at that adjusted yield curve, it is still positive and never reached negative levels. So essentially, the yield curve has actually not inverted, but because of the manipulation by the US Treasury and essentially that form of yield curve control, it looks optically like it has been inverted. So the yield curve, therefore, is not a particularly reliable indicator of recession in this scenario. And the next big argument that recessionistas are making is that because rates are coming down, and historically rates coming down has been an indicator of recession, and almost every single time in the past when rates have come down, a recession has followed shortly after, that this time will be no different, and that as rates are forecast to come down over the next year and forward-looking expectations offer a decrease in rates, that therefore what will follow this also will be a recession, as it has been historically. So the Fed watch is currently pricing in a 76% chance of a 25 basis point cut at the next meeting and a 24% chance of a 50 basis point cut at the next meeting. Now, it has to be noted that currently the probabilities are in favor of a 25 basis point, but the market was actually pricing in a 50% basis point as more likely only a few weeks ago. So currently the market is fairly skittish and doesn't really know where it stands, and it reacted quite negatively to that mini liquidation event that we had in early August. So when you look historically, it is accurate that rate cuts have also coincided with recessions. However, that is cherry picking data a little bit, because rate cuts do not always indicate that a recession is coming. So the recessions are denoted by these grey areas. And as you can see, there are occasions where rate cuts do not lead to a recession. So for example, in November 1966, there was no recession. In 1984, there was no recession. There was no recession in 1989, but then there was one later in 1990, and then there also was no recession in 1995. However, to be fair, historically, when rate cuts do come, more often than not, there is a recession and a fairly significant market downturn. However, it has to be said that rates are not a leading indicator, and that rates historically have come down in response to a recession happening and in response to weakening economic conditions. So rates coming down do not cause a recession, and it's not a causal relationship, but rather a reactionary one where rates come down in reaction to a recession happening. But that does not mean that rates coming down cause a recession. And Lynn Alden echoes this by saying, yes, but cutting from an inflationary standpoint towards normalcy is different than from cutting from normalcy towards accommodative levels. I'd focus more on unemployment and economic indicators than the rates themselves. And usually rate cuts accompany economic weakness and thus are associated with bad asset pricing. But ultimately, it's about the economic weakness or lack thereof. Focus on that and not the rates themselves. And so you can step in and say, oh, well, look at the data. The data shows that economic conditions are weakening and the unemployment rate is starting to rise significantly. And this is also echoed by Finance a Lot, who says unemployment is now going parabolic, exactly like 2001 and 2008, and that the last two crashes and the flash crash of 1987 began in September. So never mind interest rates, but the economic data is suggesting that we are going into a recession and that a big market crash is coming. And this is also echoed by the SAM rule. And the SAM rule is essentially a moving average of the unemployment rate. And when it reaches a certain level, that is a trigger warning for recession and indicates that a recession will follow shortly after. And the idea is that once it hits 0.5, that a recession will follow shortly after. And we have hit that 0.5 level. And again, this has been fairly accurate in the past, but there are instances where it has not been the case. So 1976, it triggered and didn't correctly call that recession, and also came very close in 1967 and also didn't call a recession then. So to dig into this, we're going to have to dig slightly more deeply into the data and kind of look beyond what the headlines are telling us. So we've got a little bit of a complicated chart here, but on the bottom is the US GDP growth, year-on-year percentage change. Second from bottom is the unemployment rate. Third from the bottom is the US inflation rate. And on the top is the S&P 500. So again, looking historically at the unemployment rate, generally, when you do get that rise in unemployment, you also get a fall of GDP generally going into negative territory, a slowdown in inflation generally going into a deflation, and also a market crash accompanying it. So, for example, in 75, unemployment correctly predicted a market crash. It also correctly predicted it in 82. In 1992, unemployment rose and it did predict a slight fall in GDP, but it didn't actually affect the stock market in any way. So while it did correctly predict a mild recession, there was no stock market crash in that instance. However, in 2001 and 2008 and 2020, it was also accurate. So based on this, and based on the fact that now unemployment looks like it is ticking up and looks like it is accelerating, depending on how high it goes, it is an indicator that we could be in for a recession and some market turbulence. However, you have to look slightly beyond the headlines to kind of try and figure out what is going on here. So on the top here, we have total job layoffs. Second from the top here, we have jobless claims. So essentially people claiming unemployment support. Third from the top here, we have new job openings. And on the bottom here, we have the civilian labor force level. So when you look at total layoffs, layoffs are actually going down. So the rise in unemployment rate is not due to a large number of people being laid off from their jobs. And layoff remains at a fairly suppressed level overall compared to historical data. And this is also echoed by the jobless claims data, which is not ticking up in the same way that unemployment is ticking up. And it's potential that it's lagging and that it's just taking a little while for those jobless claims to come in. But these bottom two of new job openings, new non-farm job openings, and total civilian labor force, or in other words, the total number of people in the labor force, the uptick in unemployment was caused essentially by an increase in the supply of workers and a decrease in the supply of new jobs. So the uptick in unemployment has been slightly deceptive. While it does indicate that, there is weakening in the jobs market by the fact that there are less job openings, historically, it still remains at a relatively high level. And so, when you look beyond the headline data of, unemployment is ticking up, yes, it is, but it's ticking up not because there's huge amounts of layoffs, but because there is a decreasing number of jobs and an increasing number of workers and an increase in the labor force. And this was reiterated by Powell in the Jackson Hole speech that he gave. And, generally I wouldn't trust what Powell has to say at face value, but when it is supported by the data, as we have seen, then it does lend a little bit more credence to it. So
most of that increase has come over the past 6 months. So far, rising unemployment has not been the result of elevated layoffs, as is typically the case in an economic downturn. Rather, the increase mainly reflects a substantial increase in the supply of workers and a slowdown from the previously frantic pace of hiring. Even so, the cooling in labor market conditions is unmistakable. Job gains remain solid, but have slowed this year. Job vacancies have fallen, and the ratio of vacancies to unemployment has returned to its pre-pandemic range.
And when you look at the longer-term chart of layoffs, you can see that we are essentially at record lows, and that job layoffs are not rising in the same way that they did in 2008 or 2022. So that does lend some evidence to the fact that the unemployment data is not as reliable of a signal as it has been historically, and potentially is not going to lead to the same result as it has historically. And currently, bond markets are betting on disinflation and they're not betting on recession. And this chart here shows the net percentage of countries seeing higher year-on-year inflation rates. So currently, the net percentage of countries is negative or low for CPI or CCPI data. However, it does look like it has had a macro bottom and is now trending up, and that potentially the PPI is leading the CPI and CCPI, indicating that overall the net world economy is going to see a period of reinflation and accelerating growth and not a period of recession and a huge market crash. And this is backed up by the US real GDP. So currently, US real GDP sits at 3.1%, which is relatively strong and relatively positive, and quite a bit higher than we saw in 2022 and 2023, which is when we did get very near to a recession. And, a lot of people believe we did actually have kind of a mini minor recession during that period. And the global recession probability is only pricing in a 30% chance of a global recession currently. And so looking at some other economic data, the credit spreads have nicely come down, and a credit spread is essentially the difference in yield between bonds of the same maturity but a different credit rating or a different risk rating. And when you have a high spread on those, that generally means that the yield on a riskier bond goes higher because people demand to be compensated more for that higher risk of default. And when you enter a recessionary period, such as in 2001 or such as in 2008, the spreads start to widen, but currently the spreads are fairly low. We did have a slight spike during the mini liquidation event, but it has again come down to fairly normal. And when we have a look at the VIX, again, we did have this huge spike up, but it was very quickly sold off, and it was essentially just crushed. So that is another indicator that this may not have been the sort of credit spark that sparks off a huge global recession, but was literally just a liquidation event and a risk off event. And when we have a look at the MOVE index, is essentially the VIX but for the US Treasury market. So it measures volatility in the US Treasury market market. And again, when it goes higher, that indicates a greater level of risk, such as in 2008. That indicates a period of high risk and a potentially very recessionary environment. And while it is at somewhat elevated levels, it has been trending down since 2002, and it is in kind of a sustained downtrend. And then this brings us on to the liquidity cycle. And a lot of the recessionistas are saying that the liquidity cycle doesn't particularly matter and that markets can still go down during an uptrend in liquidity. And that is true. However, the period of the liquidity cycle that you are in is a good indicator of if a severe credit event can happen. And the liquidity cycle generally leads the business cycle or the economic cycle by around 15 to 20 months. And generally, market downturns and economic recessionary downturns occur at the bottom of the liquidity cycle, and they are much less likely to happen during an uptick in liquidity. While it is possible, liquidity is a huge driver for the markets, and it's something that the recessionistas are just essentially choosing to ignore and cherry pick their data. So based on the liquidity cycle, that would indicate that we are going into a period of sustained liquidity growth up until essentially late 2025. And liquidity is a very good predictor and a very good driver for markets. So you can see in the same month that global M2 bottomed, that was the same bottom as the stock market, and Bitcoin bottomed just a couple of months later. And as global M2 has been rising from that bottom, so have risk assets. And this is projected essentially to rise for the next year to year and a half. So if it's anything like history, that is a good indication that risk assets will perform well over the next year to year and a half. And on top of that, the dollar is starting to further weaken, and the dollar weakening basically opens the spigots of liquidity and allows global M2 and further liquidity to start massively rising. So the dollar falling overall is generally extremely bullish for risk assets and is generally not what you see in a recession. In a recession, the dollar is much more likely to rise, as happened in 2008. And also as started to happen in 2020 before QE infinity kicked in and started to push it down further. So we shouldn't be seeing this during a recessionary period. And the reason that the dollar falling is bullish for liquidity and therefore bullish for equities is essentially because once the dollar starts falling, that allows other countries to basically start to stimulate and inject more money and more liquidity into the economy without running the risk of currency risk. So, as we can see, the Japanese raising interest rates to 0.25 from negative, although that is still, an extremely low rate historically, because the Japanese debt to GDP is so high, they can't have raised interest rates for any extended period of time. But if the dollar is tight and, attractive with high yields, and your currency is weak and unattractive with low yields, then that puts serious pressure on your currency. So, for example, when we look at the dollar versus the yen, since the start of the Fed hiking cycle, essentially the yen has been in a capitulation against the dollar. But with the Japanese raising interest rates, they have successfully defended the yen and gotten the dollar to a more sustainable level and more within the historical range of the yen. So it remains to be seen whether they will hike again to further defend the yen, but in my opinion, it is unlikely. And the dollar falling overall has also weakened it against the yuan, and that is very bullish for risk assets because the Chinese economy has been struggling so badly. They have wanted to inject stimulus and to stimulate their economy and essentially add liquidity to their economy. But because the yuan has been so weak against the dollar, if they had added that liquidity, they would run the risk of severely devaluing the yuan against the dollar. But now that the dollar has begun to weaken, that basically opens the floodgates for Chinese stimulus to come in and start to stimulate their severely lagging economy, which is, again, very bullish for risk assets. And, it's the classic thing to say, oh, well, this time it's different. But this time it really is different because the main driving factor and really the main focus of the Fed is the US national debt, which is currently at 35,255 billion. And if we do enter a recession, essentially the US GDP will go down and they will have to severely increase the national debt by adding a huge amount to the Fed balance sheet, therefore increasing the national debt. So if the US GDP goes down and the US national debt goes up, then the debt to GDP ratio will start to skyrocket. And this really is the number that they care about the most and really is the kind kind of defining feature of current Western economies. And they absolutely do not want this to happen because the national debt is already far out of control and risks spiraling even further out of control if a severe recession does come in. And so it's currently at 35.255 trillion, whereas just a few days ago on August the 21st, it was at 35.176 trillion. So it's increased by essentially 75 billion in the past few days. And people who are calling for this Great Depression or Great Recessionary event, we have essentially already had that. The Great Recession and the Great Deflationary event was in 2008, and that mimicked the 1929 Great Depression. And after that point, you leave the realm of monetary dominance and you enter a period of essentially fiscal dominance, where the private sector and bank lending has much less of an effect on economies than essentially federal deficits do. And economies are now driven primarily by governments, and it is a much more controlled economy. And the reason for this is because past this great deflationary event, like we had in 1929 or like we had in 2008, household debt or non-federal debt decreases as a percentage of GDP. So that's things like, mortgages and credit cards and any personal debt that you may have. But after that period, federal debt, or in other words, government debt, as a percentage of GDP rises because essentially the private debt is socialized onto government books and onto the Fed's balance sheet. And so we are now essentially in the period of the sovereign debt bubble, where 2008 and 1929, that was a whole load of private over-leveraged players taking on too much debt and then becoming over-leveraged and having to be bailed out. But at this point, it is the government and the Federal Reserve that is massively over-leveraged and in far too much debt. And that essentially is why this time it is different, because at this point, you run the risk of a sovereign nation going bankrupt instead of just a few hedge funds and a few banks. And a sovereign nation going bankrupt would be so much worse than an event like 2008 or 1929. So they cannot let this happen. And this chart once again shows that overall, as a percentage of GDP, household debt is growing down and federal debt is rising as a percentage of GDP, which was exactly the same that happened in the 1930s and the 1940s. And on top of this, if a Great Recession does come in, then the government runs the risk of federal government current tax receipts falling significantly. And if tax receipts significantly fall, then unless they have a significant decrease in spending, then the deficit will start to grow even larger, which will then make the debt problem even worse than it currently is and start to accelerate at a faster rate than it currently is. So that again is something they seriously want to avoid. And the same is true for federal government current expenditures in the form of interest payments. Federal government expenditures in the form of interest payments are currently ballooning and have reached essentially over $1 trillion, which is essentially around 25% of all federal government income. So 25% of everything that the US government brings in is going purely to service the debt, not even to pay the debt down, purely to service it. And so this is a big reason that the Fed needs interest rates to come down to bring this down. And they are not necessarily cutting interest rates in response to a recession, as has been historically what they have done. But instead, this time they need to cut interest rates because they need to get the interest payments on the government debt down. And once again, if a severe recession does come in, then the debt will have to increase even more and the interest payments will become even more difficult to service for the US government. And so when you look at a chart of the S&P 500, these two events, the British gilt crisis and the SVB bank collapse, really were two events where the Fed showed that they will not allow that recessionary event to occur, and they will step in when there is systemic risk to the credit markets. And the same with the Bank of England. They basically pivoted from quantitative tightening straight to quantitative easing as soon as there was a significant amount of pressure on the British debt market. And so, if the Fed stepped in here for the significant, refinancing crisis and credit event of SVB, which could have become so much worse, and if there hadn't been that Fed intervention, it would have become a lot worse, and it would have sort of exposed the brittleness and the fragilities that exist within the current system. If they were going to allow this huge recessionary event to happen, then why would they not have allowed it here, and why would they have stepped in here? Because they're not going to allow it to happen, and they can't allow it to significantly happen. And so, if there is another significant credit event, and, we could certainly have a period of downturn and potentially some more market volatility. But if there is a significant credit event and a significant refinancing crisis, then Why would they allow that to happen? And why would they not step in and, buy all of that bad debt and put it on their balance sheet? Do you think it's realistic that they come in and as soon as there's any sort of pressure in the debt market with SVB, they immediately step in? But then if there is a significant credit event, that they will just let this one play out and they will let a significant, serious downturn occur in risk assets. And it's not really about the risk assets. The Fed doesn't really care about risk assets. They care about the sovereign debt market. But an event like this would also be incredibly bad for the sovereign debt market and would essentially break it and run the risk of a sovereign going bankrupt. So, you have to ask yourself, why would they step in here, but they wouldn't step in here? I find that very, very unlikely. So, to summarize, the yield curve is essentially deceptive due to the Treasury performing a form of yield curve control and essentially a form of quantitative easing. Interest rates are not a leading indicator and historically have been in response to a recession, but therefore rates themselves are not a reliable indicator and are not a reliable predictor. And in this case, rates may be coming down not in response to recession, but instead in response to that ballooning interest payment that the government inevitably wants to bring down. And, the labour market clearly is softening and there is economic weakness emerging, but looking beyond the headlines shows us that essentially it is not quite as bad as the headlines and as the doom posters and top callers make it out to be. And GDP remains strong in this period. And while it is likely that unemployment rises and GDP does come down, the rate cutting cycle will be a positive factor for that growth. And, on top of that, we are in a liquidity upcycle, which is immediately positive for asset markets and acts positive for the overall economy, but with a lag. And on top of that, we have a weakening dollar, which is allowing global M2 to rise as other countries, especially China, can then begin to stimulate without currency risk. And the US sovereign debt is now the insolvent domino. The Fed will not allow the US debt market to break, and they will intervene if they need to. And, while it is certainly possible that we do have more market volatility and a slight downturn, for another 1929-2008 style recession, something in the debt markets would have to break. And SVB and the British gilt crisis showed us that that will be avoided at all costs. So thank you very much, you guys, for watching. Don't forget to like and subscribe, and also leave a comment if you do like this type of content. And to end this video out, we're going to watch a clip which I think summarizes what will happen if things significantly do start to break.
Mark. Paulson and Bernanke just left the White House. There's going to be a bailout.
Well, they had to, right? I mean, paper markets would have
They
collapsed.
knew.
Cash would have stopped coming out of ATMs. They had to backstop this.
They knew the taxpayers would bail them out. They weren't being stupid. They just didn't care.